Well, tighter monetary policy in China and tighter regulatory policy in the US seeing the markets in a spin. But isn't this just a matter of a necessary deflation of what some had been calling overinflated exuberance anyway?
Well, I'm not sure about that, but what we have seen is just a reaction to the bad week that we've seen from China as well as from the United States. I mean, Greece is also still, a bit of a problem at the moment. But I think, it is a proper reaction. What Obama has proposed and what may end up happening will be to curb the liquidity in the markets. If banks are not now allowed to invest in certain ways or to grow to certain sizes, it does affect the liquidity of the world markets, and that also trickles to the liquidity of commodities, the liquidity in currencies, and speculation perhaps is also now being curbed back. Things that used to drive the market. So it's a very big change in playing fields, and yes, I think this kind of reaction is warranted because it is worrying times.
Just looking here in South Africa, we've seen our resources this week really coming under pressure on the back of that news out of China, but where resource companies are still making positive news. I mean, today, DRD Gold, one of them saying that it's agreed to buy a 50% stake that it doesn't really already own in Ergo Mining. Should we be taking this as a signal of sentiment that the actual players within the sector are currently holding?
Well, I think you point out two important points there. I mean, the first one would be DRD's intentions to buy the remaining 50% in Ergo, would suggest that, they've done well. The commodities cycle was very strong last year, and, gold prices increased quite a bit last year, so they've made a little bit in order to expand themselves. And also on the other side, you point out that China, came out saying that they may curb some lending, or they're encouraging banks not to be so free in lending, which then obviously goes out into the demand side and of commodities, and will end up curbing that or bringing that back a little bit. So going forward, and we expect that commodities may actually be a lot less lackluster than we initially thought. And I think what we're seeing from DRD is just a reaction of what is currently in their books, the kind of money that they may have and the kind of opportunities that they see opening. So whether that is going to carry on, or whether those kind of opportunities will come up again or exist in the market, I don't think so in the near future.
Especially in a context where we've got domestic issues like Eskom tariffs hikes to consider, which will certainly have grave implications as far as production costs are concerned, possibly more than just denting bottom lines despite the level of production we're seeing coming online.
Yes, I think especially the miners would be facing a lot of problems coming up with that Eskom proposed hikes of 35% per year, I think it is, and and also commodity demand perhaps coming down from China, the largest demander of commodities. So I think it's a very difficult times ahead for miners at the moment.
Difficult times ahead, and possibly difficult times to even forecast. But nevertheless, Ntombenhle, what's your outlook for the gold price? We've seen it moving below its key resistance level of $1,100 an ounce. Where to next for the yellow metal in your books?
I think, we saw we're currently sitting at about 1,095, slightly below the key support level of 1,100. So, I think it will take some time. China needs to come back and demand, or they need at least to have a clearer picture of how they're going to curb lending on that side. And, we need to have a clearer picture from the United States also as to how this will affect commodities, this limitation of what's going on, of what banks can participate in, and how banks can influence liquidity and demand in the market. So I think going forward, we'd perhaps expect to see the gold maybe trying to go to the 1,200 where it reached the last time, but I don't think we'll be seeing, within the next 3 months, the levels that we reached of 1,220 last year.
Talking about banks and them influencing liquidity in the market, let's bring it back to home ground. Of course, we're waiting for the MPC decision on interest rate next week. What's your outlook, especially where we've seen retail sales haven't been that good?
Yeah, I think at Nedbank we are expecting that there will be no change, particularly for 2010. I think we expect only to see maybe interest rates go up from next year, 2011. But I think what the retail sales data has shown is that the consumer is still under a lot of pressure. With all the cuts, the 500 basis points cuts that happened last year, from late 2008 to August last year, have not really translated to the consumer. Consumer is still under pressure. And for the central bank to now start raising rates will be a little bit too soon. The economy hasn't been fixed by that yet.